All right, this is something called a volatility index that is a gauge of fear. It was hitting highs we had not seen throughout the entire bull market briefly on Monday and really Tuesday morning. Then it dissipated a bit, but it's very volatile. It changes oftentimes by the second. Nevertheless, this has gotten to be such a creative index that people invest in it. And then there are two alternative indexes. I won't repeat the names for it, although they will pop up here, because a number of investment houses, including Credit Suisse and some others, have used this as a way to counter this one, this volatility index. Now you're saying, Neil, why are you boring me with this information? Two reasons. One, I am boring. And secondly, I think you should be made aware of this because it can oftentimes exacerbate trading to the point that it gets crazy. It doesn't separate the fact that there are trends that you can't deny, but what happens is it can put them on, hyperdrive, on steroids. Trader Stephen Guilfoyle is with me right now, goes by Sarge as well, so he served this country honorably, and he's worth a lot of respect because he sees the big picture trends here. You kind of like the big picture trend you're seeing right now, but you're not unaware of how these other factors and, can magnify it. Explain what happened.
Well, I mean, obviously everybody was shorting risk, volatility, and they were finding ways to do it that I'm not really cool with. I don't like inverse funds. I don't like leveraged funds. I avoid them completely, not just for volatility, but for any sector or exotic type.
Why is that? It's said to be a way to hedge that. I mean, like program trading insurance was, portfolio insurance was in the 80s. Of course, we know what happened in the 87 crash. But this was the latest flavor of that, wasn't it?
Yeah. I fancy myself a stock picker. I try to be my ETF. But in areas where I'm weak, if I need some exposure to the transports in a hurry, I will go ahead and buy the ETF, the XTN, just because I might not just want to be in one airline and two railroads overnight. I might want to have a broader
index
picture
of the transport stocks.
Right. And I'll round out my portfolio that way. But I truly believe, and some people may disagree, but by leveraging or inversing an index or an exotic specialty, you're putting yourself at risk that you don't understand. And if I don't really understand what this will do to my portfolio, then the average kid on the couch is not going to get that.
But a lot of people, and there are some smart folks at Credit Suisse and these other institutions.
I worked there for 13 years.
Sure. So they come up with a product that gets very popular, right? Everyone wants in on it because it does sound good. It's a way to, I guess, counter whatever you're seeing in the CBOE, the VIX volatility index. But is there a way to make money on fear, bottom line?
Well, you got to remember, for every dollar made, there's always a dollar lost. And the way markets trade now, they're fast. They're much faster than they've ever been before. When the market was down 500 points the other day on Monday, I actually tried to buy a basket of stocks, but I tried to do it by hand because I'm a guy. And I bought a few shares of one stock, but all the other stocks I missed them because the market was back 400 points before I got the orders in. And
you're a big guy in this. I mean, you're not some sort of Joe also-ran.
No, but I was reacting to it, which you're too slow if you're reacting to it.
But there are all these other guys who have these computerized algorithms and trades. I was talking to an algorithm expert the other night. Mind-numbingly smart, but mind-numbingly like, whoa, this guy's so over my head. And he was explaining how it works. It's just a touch of a button. It's unemotional. It's based on a variety of factors. There are a gazillion algorithms. This and these other, indexes, these other ETFs, whatever you call them, are counters to it, part of it. But they're all set in motion in real time, rapid time. And it will exaggerate moves, won't it?
Yes. The way I feel you combat this is to go to a minimal increment per price, let's say a penny, let's say a nickel, something like that, and to centralize trading for each of these securities, be it at the New York Stock Exchange, okay, I'm biased, be it at NASDAQ, whatever, but each one has a home, and most of the trading has to occur there. This way there's a thicker book. So you have a centralized...
You're telling me if you're waiting, and you're a big deal, that you're waiting to get your order through, I can't imagine where I am. So I'm just wondering, what happens? Is this a fair process?
I don't think so. No, I mean, I believe the open outcry process was the fairest ever because I'm partial to it. But what it did...
That's gone.
It's gone, but we can still have that centralized location I was speaking about. We can still have 5-cent increments instead of tiny increments. You can still put in a speed bump. How about a speed bump? Nobody talks about this anymore. Let's slow down the process just a little bit. You know, when I was a kid, we had 3 minutes to get you your price. 3 minutes.
Wow.
On the front page of the Wall Street Journal's website right now, they're talking about the Olympics in milliseconds. Well, stock trades are measured in microseconds, which is a lot faster than a millisecond.
I worry about another flash crash. Now, people don't mind when it flashes up. They mind when it flashes down. They don't mind it when it goes their way. They mind very much when it doesn't go their way. That's human nature, I understand. But do you think now, first of all, it's too early to tell whether things are settling down. It would appear so far so good. But are you worried about the next time that these, I think it's like open the pod bay door out. You know, it's like one of these 2001 developments that could take a market trend and just take it to extremes.
Oh, you know it's out there. You know it's already out there and it's already hunting us down. Well, you might not see where it is or where it's coming from just yet, but we saw a flash crash in 2010. We saw what happened with China in 2014. This happened the other day where in a matter of seconds, the market went from being down 800 points to down 1,500 and back to down 1,200.
Do we have to get used to that? This is the new way of the world?
You have to get used to volatility.
Yeah.
Okay, we should have more volatility than we had for the past 10 years.
The big thing we've been spoiled on is a lack of volatility.
Right. There's going to be more treasuries for sale. There's going to be the biggest buyers being removed from that market.
Yeah.
The bond market is going to retake control over interest rates, not the central bank. That is going to force some volatility in those markets.
Are we done through the worst of it in your eyes?
What's that, boss?
Do you think we're through the worst of it now?
I feel that right now we've gotten through the worst of it, and this SXVY, it looks like their assets have quadrupled in the last 24 hours or so. So, yeah, as long as that doesn't reverse, we're out of the woods for now. Are we ever really out of the woods? Do you know you won't get hit by a bus tonight on the way home? We never know.